Good morning, good afternoon, everyone. My name is Heidi DuBois, and I lead the ESG Strategic Advisory Services Group at Edelman. We are the largest PR and communications firm globally with 6,000 employees in numerous locations. It's a real privilege to be here because ESG is near and dear to our hearts, and particularly in terms of how ESG factors are incorporated into business strategy and decision-making through a business. We're here today to discuss what does stakeholder capitalism look like? There's no better time to be talking about this topic, obviously in the wake of a year that, like no other for most of us. So before we jump into the conversation, I'll briefly introduce the panelists, and then we can jump in right away and get started on what's top of mind for them. So first of all, we have Kevin Dancey, the CEO of IFAC. We have Rodney Irwin, who's Managing Director and member of the Senior Management Team at the World Business Council for Sustainable Development. We have Andrew Harding, CEO of the Association of International Certified Professional Accountants. And last but certainly not least, Geraldine Matchett, the co-CEO and CFO of DSM. For those of you who are not familiar with DSM, it is a life sciences and material sciences company that is Dutch listed, has produced an integrated report for over 10 years. I'm pleased to also inform you that Geraldine was trained as an accountant, and it's maybe been some time since she has practiced as an accountant, but her perspective is uniquely valuable in this conversation. So with that, let's just jump right in. I'd like to start with asking exactly that. What issue is top of mind for you that this audience needs to know about now? And Rodney, maybe we can start with you.
Indeed. Well, thank you very much again. I'm delighted to be part of the panel. So what's at the top of the WBCSD's agenda in terms of this notion of stakeholder capitalism? I think 2020 has brought us what we would associate with 2020 vision, which is a very clear understanding that we are at a point of inflection and that we need to change. And the existing capitalist model that we've had is not necessarily sustainable, either societally, environmentally, or economically. Capitalism's core features of private enterprise and competitive markets are, however, indispensable if we are to achieve the scale and speed that we need for the transformations that 2020 have showed us is very necessary. The capitalism we need is one that rewards true value creation, not value extraction as today's model does. All social and environmental costs and benefits, in our opinion, should be internalized and reflected in the relative price of goods and services and in companies' P&L statements, costs of capital and market valuations. So at the top of our mind is the need to take advantage of the positive aspects of 2020 and the COVID-19 pandemic, and to start to totally integrate ESG as an outcome of business strategy and not just as something that some companies do on the side. So that would be our priority, as an integrated model and where the finance community, the accounting community is totally on board with how we need to create a transition to a more sustainable capitalist system.
Yeah, Rodney, I've heard you talk about how CFOs and accountants can be quite influential in terms of shifting ESG from straight up reporting to a component of decision making at the leadership level. So it's great to hear you talk about how serving the public interest is also serving business. Andrew, speaking of CEOs and finance teams, bringing it to ground, what specific role do you think these professionals can play in evolving towards a multi-stakeholder model?
I feel like I've spent most of this year talking to CFOs about change, about the pace of change, and I think we can all be, one thing we're all certain of, things have happened over a period of weeks this year, which would have taken us years otherwise. For me, CFOs need to be making the case for how non-financial drivers are key to not only decision making, but also to resilient businesses and long-term sustainable corporate performance. For that, they're going to be needing to work on integrating these into their organization's strategies so that those drivers are appreciated, so it's built into their plans, so it's taken into account when they're allocating capital, and going further than that, right into their performance management and incentive and remuneration schemes. So it's all encompassing. For a long time, finance has measured more than the money when it comes to management information, and it needs to be really doubling down on that and working on that within this sort of multi-stakeholder framework.
I think that's a great opportunity to speak with Geraldine about integration. Given that DSM has prepared an integrated report for over 10 years, perhaps you could describe some of the processes and practices that you all have deployed to do exactly what Andrew and Rodney have spoken about.
Yeah, if you don't mind, I will step up first before going into the how, because I'm a great believer that often if the why becomes obvious, the how is a lot easier. And having the privilege of leading a company, which is a stakeholder-led company, purpose-led organization for many years. I mean, we've had a triple P, people, planet, profit, bottom line for more than 20 years. Our incentives are 50% financial, 50% non-financial across the whole company for more than 10 years. And so we have a lot of history behind this, but when you actually look and say, why did we do all of this before it became maybe as obvious as it is today that this is mission critical? And it was probably because being a Dutch listed company, the why was clear from the very beginning. Under our articles of association, our responsibility as leadership is to all stakeholders. And that was actually quite different from the Anglo-Saxon system, where you would say the primary fiduciary duty of the top leadership is value creation for the shareholders, and the rest is the responsibility of government, etc. So I would say that step one in any company is to really think very carefully what is mission critical and why should anyone bother with these things. Otherwise, it will go at snail pace. Now, having said that, I think I fully agree. And I think it was Andrew who said, you know, we've achieved in a few months and weeks more than we've done in many years. And that's because the world has woken up to the fact that there is an interconnection between companies, society, the environment, and that what may have seemed sort of manageable in pieces, actually that is not true. Everything is interconnected. And therefore, as a profession, and being indeed an accountant by training, we know that we have as a profession been able to have the trust of all stakeholders in what we always signed off on, which are the financials. And over time, we've started to indeed do a bit more. Now we just need to go much faster and embrace the fact that measuring success for a company, but across the broader spectrum of a society, we actually need to have the same degree of structure, of rigor, of assurance than we've had for many years on finance. And then from there, you start moving on to the how, which is not very different from how we did it on financials, if I'm honest.
So really embedding this into existing processes and procedures was sort of a natural approach for you.
Absolutely, but it started with why would we want to do this? And I, you know, if you capture the hearts first of your function, and hopefully you can do that in full integration with the company, because I don't believe you can do it if it's not actually embraced by the whole organization, then you generally find the how. And I'm sure we will go later on in this panel conversation into the sort of where are the difficulties at this point today.
Yes, and just a quick comment on that before we go to Kevin. I was actually speaking with the chief human rights lawyer for a large company in the United States. And that individual's belief was that because the organization had adopted the language of human rights over the past 4 years in terms of operations and supply chain, they were able to react much more quickly and make decisions about obtaining and providing personal protective equipment to their employees, which in turn enabled them to preserve their supply chain and maintain their operations more quickly than competitors. So I don't know if that resonates with you, Geraldine, but it's a recent discussion that I had that I thought I would share.
Fully resonates. I mean, to give you an idea, we have about 25,000 colleagues around the world with production and distribution in all geographies. So, you know, the breadth is a factor when you look at a pandemic like we've had. And therefore, it very much resonates that when you've embedded in your culture things such as trust, things that you measure the impact on people and planet as much as on profit, when you're in the middle of a crisis, your values are so well anchored that you can actually let go and let your organization solve everything. So we shifted, for instance, because we're purpose-led, we've never made hand sanitizer before. We've never made swabs for the testing of corona. We just switched into it within days because we said, well, we're a science-based company. We've got the capabilities. Let's see what we can do. And we actually started producing these essential PPEs for society around us, not because we, as the leadership, said we should do this. It just happened. So when you have something very well anchored in the organization, it takes you through these kinds of crises much better.
ESG, culture, and resilience and performance sounds like a very logical chain in terms of production. So on that, Kevin, can you speak a little bit about the role of accountants in enabling this wider approach? And ultimately, investors are going to be consuming this information and are increasing, maybe implementing new expectations on ESG reporting. What do you think is needed for this profession to be effective in integrating these considerations into their reporting and decision making for their companies?
Thanks, Heidi, and happy to be here. I think at its essence, we have to think of this in terms of the 21st century that we're in right now. And stakeholders need to know that a business is proactively identifying opportunities and risks that are financially material, and I'm going to emphasize that are financially material to its business, that could lead to either long-term value creation or destruction for that business. And they need to know what the business is doing to seize those opportunities and mitigate those risks. I would say that's it in like a 1 minute, 25-word summary in terms of what is needed out there right now. And frankly, I don't think stakeholders and investors get that right now, but they do need it in a consistent, comparable, relevant, reliable, and assurable manner. They need more transparency, and they need better data to benchmark. I'm really talking about investors now, in terms of investors looking at a business to kind of benchmark this business or this opportunity versus that opportunity. They need better data to benchmark, and they don't get that right now in a consistent way. And there's really weaknesses in the data structures. And I think the final point I'll make is that it's not just about the reporting. And I think Andrew talked about this earlier. I think it's very important for stakeholders, investors, et cetera, to really understand the culture and the mindset of the business as to how it's approaching this. So it's not just about the reporting out. Does this really kind of go through the organization? If I think of the CFO or Chief Value Officer going forward, how do they look at long-term value creation and risk mitigation? And I think the role of accountants in that is, and to quote Peter Bacher, who's not on the panel today, but one of his phrases I heard a few years ago was, only accountants can save the world. And what we offer as an accountancy profession is, it's the language of business, right? Mm-hmm. In terms of a business has a story to sell, in terms of to provide to stakeholders, and then stakeholders want to understand what that business is doing. And how are they dealing with all these various issues? I think that's the role of accountants, to help internally in the organization to develop that mindset of the Chief Value Officer, to get that working in the organization, and then to get the reporting to work. The reporting to work so that the entity can get its story out and put it out in a way through technology, et cetera, so that the users of the information can extract from that report what they need. So I think there's a lot that accountants can do. I think it's going to involve new competencies, new skill sets. But I think this is, I think as somebody else said earlier, I think it was Rodney, that we're at a real tipping point and inflection point right now in terms of moving this agenda forward. And I think people are going to look back 5 years from now, 10 years from now, as to the decisions made today. Did we make the right decisions to move this agenda forward?
I think we could do an entire panel on the role of the chief value officer. I'm going to take that away and think about what that job description would be. Just super quick before we move on to the impact of COVID, Kevin, are you able to opine on where you think standard setting is now, who's best equipped to do it, and how long it's going to take to get there?
Sure. And if you watch this file over the last year, this has been an extremely busy year. There's been so many initiatives this year from Europe, from IOSCO, from the World Economic Forum and the big four firms, to what I call the Gang of Five, the alphabet soup of ESG reporting, SASB, GRI, IRC, CDB, and CDSB. They have come together, as you may know, in terms of putting out a report in September about how they're starting to work together. IFAC put out a roadmap in September in terms of how we saw the way forward. And the way forward that we see is that the standard setting in this area should fall under the auspices of the IFRS Foundation. And we were very pleased that the IFRS Foundation put out a consultation paper at the end of September. We think a new sustainability standards board operating alongside the ISB is the way to go, really for, I think, a number of reasons. One, these issues are global and it needs a global solution. And the one entity that's out there that has a really proven track record in terms of global standard setting is the IFRS Foundation. It has relationships with over 140 countries around the world and the regulators in those jurisdictions around the world. I think the IFRS Foundation also has the backing of the public authorities. I'm really talking about IOSCO here. And I think without the backing of the public authorities, this issue will flounder. It just needs that to make it work going forward. And I think there's such a connectivity between what happens in terms of financial reporting and what happens in terms of non-financial reporting. They need to be connected. On the financial reporting side, the ISB is looking at its management commentary, for example, in terms of how is that going to relate to non-financial reporting. So when both of those boards are under the auspices of the IFRS Foundation, there's going to be a connectivity there, so there's no gaps and overlaps. So certainly from IFAC's perspective, we see the IFRS Foundation as the place to house this sustainability standards board going forward. We'll be very interested in terms of the results of the consultation process that the IFRS is going through right now. That closes at the end of December. And if I had one piece of advice for the IFRS Foundation going forward, I would say, well, more than one piece of advice. One, yes, do it, proceed, but don't think you have to start from ground zero and invent all of this, because there are so many frameworks out there, SASB, GRI, IRC. Leverage the work of others, because pace of change is important. And it's just important that, we don't lose pace and momentum on this file as the IFRS figures out how it wants to approach the issue. So I think, I'm hoping there will be great discussions and connectivity between what I call that Gang of Five and the IFRS Foundation to develop a way forward that can move forward with pace. And they've obviously identified the climate file as the first one to deal with. No surprise there. It is the elephant in the room. It's a very pressing issue. So I'm certainly hopeful that the IFRS Foundation will pick up the mantle and move forward on this issue.
Thank you. That's really instructive. And I think we all remain hopeful that standards will converge. I've heard about pace, acceleration through COVID. Rodney, maybe you can give us your point of view on Mervyn King's phrase, coronanomics. What can we learn from the COVID crisis that can support a more resilient, sustainable, stakeholder inclusive capitalism at speed? What have we learned and what can we take from this?
It's a really good question. At the time of recording this panel discussion, COVID-19 continues to have a devastating impact on the lives and livelihoods of many people around the world. And it has revealed some very strong and startling hard truths about the scale of the systemic risks we face as a society and the lack of resilience built into our current operating models, whether that's at a government level or at a business level. But if we start looking at what we see in business, is we see that business is underinvested in preparedness. We have, this should not have been a surprise. COVID-19 is the fourth major health issue in 18 years. It's the second pandemic in 10. It's the third respiratory illness. This has been on the cards, but yet companies and businesses have failed in pretty much across all sectors to see this coming. Even the World Economic Forum's report in January had said the likelihood of a health pandemic was too remote to put into the top 5. Well, that was clearly wrong. And I think that's because we're obsessed with old ways of working. We believe, and accountants are part of the problem here, we believe that we can predict the future. Well, we should not be doing that. We need to look at new ways of identifying and prioritizing responses to these types of issues. And the current obsession with probability perhaps needs to be relooked. And if we look then at another issue that's come home to roost this year, is that there's been too much efficiency and short-term value obsession within business. Resilient systems and resilient businesses are typically characterized by the very features of diversity and redundancy or slack that efficiency seeks to destroy. And I think as a member of the accounting profession, we have been welded to improving efficiency and removing slack and assuming that everything else would be great. But that's proven that for those businesses that are resilient, they've managed to create some slack in their supply chains within their businesses. So I think we need to learn from the lessons that this year has brought us. And we need to look at 2020 through that lens of positivity, because if we fail to act on the signals that we have received this year, then the tsunami that's coming behind it in terms of ESG impacts and dependencies, whether that's the climate emergency or biodiversity loss, are arguably going to be even greater.
So Geraldine, it'd be interesting to hear you react to Rodney's comments. You mentioned that embedding and a PPP way of thinking into the culture enabled you to pivot pretty quickly to produce what was needed to combat COVID. In terms of being prepared, although you might not know what you are preparing for, I mean, how have you built in this type of flex or buffer into the business planning in a way that continues to generate financial performance for the company? And maybe you can riff on that from a COVID lens.
Yeah, I mean, this one, and by the way, I fully agree with you, Rodney. I think there's the value extraction obsession of the last decades has meant that everything is, just in time, just enough, minimalistic. Now, that's where actually, when you start running organization with a broader mandate of stakeholder values and stakeholder interests, you start taking a different time horizon. And I'll give you a very simple example. In the middle of the second quarter, when the pandemic became truly global, the questions came up very clearly. Do you slash jobs in the middle of the storm when people have no chance to find another job? Or do you just say, hey, hold your horses, we're in the middle of the fog, who knows what's going to come next? Easy. And when you, over years, have been running a company with a triple-P bottom line, and you've put in place all of the mindset and the procedures that people are equally important as profit, and you have developed an investor base, a shareholder base of like-minded investors, you actually find it much easier to get through. And I can tell you this from reality of the conversations I was having with our shareholders at that point in time. And it was very, very good conversations. In fact, I would argue is the best conversations I've had with our, investor base in many years, because suddenly those who invest on Excel spreadsheets where it's all about numbers had no idea what to do, because we could not give them numbers, not because we were secretive, we just didn't have them. There's a complete question mark, don't know. And they had nothing else to think about. Whereas our ESG investors who had been following us and been in conversation with us were asking us questions like, how are your people doing? How is everybody responding? What is your management organization right now? Are you continuing to invest in your innovations, or are you pulling back? How is the relationship with customers? And they were really going into the reality of what it takes to run a company. And by the way, they all gave us the same message. They said, don't worry about Q2. Don't worry about Q3. We would even argue we don't care about 2020. What we care about is, are you going to come out strong when this storm blows over? So are you continuing to maintain the company strong? And that is the true value creation of ESG inspired management and purpose-led management, is that you are really thinking always on a different time horizon, and the people are there with you.
One CEO that I once knew said, if you're looking at the dashboard in your car all the time, just be sure you're not going to drive off a cliff. Look up.
Exactly. Look up. And for most sources of capital, it's not the results of 2020 that matters. What matters is whether you come out of the crisis in good stead, both in terms of reputation, in terms of your supplier relationships, your customer relationship, your license to operate with society. Because if you take all the hard-nosed measures that are not stakeholder-minded in terms of the equilibrium between your dividend policy, your employment policy, your remuneration policy, your environmental policy, but you start, when the push comes to shove, you skew it all to, okay, back to short term, then you lose the credibility going forward, and logically so. So this is indeed, it's about, chin up, look through the storm, and make the choices that will serve you best. And so if normally the two go together, if you do the right things, usually your stakeholders all benefit into the mid to long term. And what I find amazing is, I am absolutely convinced, and I'm on the board of Focusing Capital on the long term, and they're still going to run the data, but I'm pretty certain that the financial performance of those portfolio managers who invest with that are either PRI signatories or invest with this broader mindset will have performed a lot better over the period than the more numerically driven investment strategies.
Kevin, I know you have a response. I just want to insert a piece of data. Edelman just published its 4th annual Investor Trust Barometer, releasing findings of a survey of over 600 investors representing 28 trillion in assets. And one finding is that trust is essential for investors to enable a company or give that company a license to lead through crisis and recovery. So I think that's really adjacent to what you're saying about your relationships with investors and the investors that you're seeking in your stockholder base. I just wanted to share that bit of data. And then Kevin, let's hear your response, and then we'll go to Andrew to talk about the nitty-gritty on how CFOs and accountants can contribute to this.
Yeah, I just wanted to pick up on what Geraldine said, because I support what she said. I just want to also put it in a context, though. I think, when you look at asset managers today, like State Street or BlackRock, they're all, looking at long-term value creation. So I think there's been a real mind shift. And the way I started my discussion earlier, where I talked about, looking at the opportunities and risks that are financially material for the business. I think any investor nowadays, and I put all investors in one group. I don't say there's a financial investor and an ESG investor. I just put investors in one block. I think in the world we're in today, they are looking at all these issues. I know we hear about short-termism and that's the financial reporting, et cetera, but I think investors have moved that they are looking at long-term value creation. And I think they're looking at all of these ESG factors, for example, what's the customer reaction? Geraldine talked about, slashing jobs at the beginning of the pandemic. Okay, so say a company did that, and an investor is looking at it in terms of the long-term value creation in the entity. What is it going to do to that? What's it going to do to the reputation of the entity? If there's certain supply chain things going on in that entity that have a bad reputational impact on the company, I think investors are taking all of these things into account that are material to that entity or could be material to that entity in terms of its opportunities and risks. So I really think it's important as we think about investors going forward and big investors like asset managers. I think there's been a mind shift there that they are really thinking in terms of a broader spectrum. And I don't think they're just financially driven in terms of short-termism. So I think it's just important to keep that into account, particularly as we look forward in terms of developing the standards that are needed to make sure they have the right information going forward.
I agree and also have a concern with that. I believe you're absolutely right that there's absolutely a bigger number of investors who are looking at all of these elements. And by the way, the better we as corporates, and therefore with the help of our accountants and our auditors, can provide insights and transparency on these things, the better. Having said that, unfortunately, there's still a fundamental issue with the financial systems right now. And FCLT has done an analysis of where is the capital coming from. So you have the big pockets of pensions, insurance companies, retail investors, etc. And where is it actually sitting today? And unfortunately, by far, the biggest chunk is actually index-driven, algorithm-driven trading. And I think the stock pickers, the actual portfolio managers who make decisions are indeed looking at these broader aspects, and thank God for that. But one thing that will be very important is for the industry to, and I'm talking the asset management industry, to start driving and developing indices that really embed ESG criteria so that even the computer-generated trades somehow pick up some of this, because right now that pot is big and is getting bigger. And they will actually be releasing, I believe before the end of the year, or maybe in Q1, FCLT will be releasing this analysis, which shows a very stark contrast between the long-term ambitions of the capital holders and unfortunately the dynamics behind the trading, which is much more short-term still. But I'm very hopeful that it is shifting though. So I'll end on a positive.
Let me just jump in, Heidi, with one other comment on that, and that's a great observation. And I think one of the reasons underlying that is that it just points to the fact that there's the right information is not getting out. There is weakness in the data structures. There's no consistent, comparable way of benchmarking companies across the ESG agenda, and that's one of the goals in terms of that all the people have been talking about in the last year is coming up with a consistent global framework to move this agenda forward. So hopefully, if the IFRS Foundation can move forward in this area and we can get a good global framework to build on, it will assist the asset managers of the world who are actually crying out for this information, but not getting it in a consistent, comparable way. And there's, we know there's boilerplate going on and greenwashing going on. And so it's just important to move forward in terms of that reporting landscape. And hopefully that'll be, a part of the solution as well.
Just quickly, and then we'll go to Andrew, who's been observing this conversation for some time. Index formation. A lot of the ESG indices today are formed based on ESG data aggregators, rankers, and raters, which creates a capital allocation issue if the data is quite inconsistent and the qualitative components are also inconsistent. That's a whole different conversation about how capital allocation is determined through rankings and ratings. For companies that don't have the resources to deliver on some of the things that Kevin is describing today, or to monitor those rankings and ratings, they may be missing out on selection for these indices, which is another topic, but in the context of this conversation might be worth mentioning. So Andrew, you've observed this mini debate. I feel like it's the election. What are your observations on the candidates, Andrew?
I'm not going to take sides. I think it's pretty clear that I'd love us to move away from talking about financial reporting and talking about ESG reporting and just talking about one corporate reporting. I think that's ultimately where we have to get to: objective, transparent corporate reporting. But as we've gone through the crisis, probably the most valuable piece of work that we've done for business has been what we called our business recovery toolkit. Some of that was short-term stuff around cash management, scenario planning, that sort of thing. But we had a bigger piece in there, which was around reshaping your business model. And that all starts by looking at the place of your business in the world, the ecosystem, in particular who your stakeholders are. And when you start doing that, you start to see that old ways of thinking where there was sort of primacy of the investor starts to break down, and you see your stakeholders as being your customers, your supply chain, the communities in which you've got your business operating in, the governments hosting your businesses, and your people. Going on to what Rodney was talking about, driving down cost so it kills your suppliers. Suddenly in April, May, people go, we need our suppliers to survive. How are we going to do this? We've cut them to the bone. We're going to have to start reshaping that relationship. So there's that's the very start of all of that. Actually understanding how those relationships work, how they're important, what's important to those stakeholders. That then gets embedded into your operating model, into your measurement, and you then start to get that slack of capacity, or that, if you like, that contingency, which gives you resilience. It also gives you strength of resilience with your customers. It gives you trust with your suppliers. It enables you to be moving in mid-2021 how you want to be. It enables you to restart. If you're not managing that, you don't stand a chance. We see talk of a K-shaped recovery at the moment, and we see businesses who've been agile, and they've been able to be agile because they've understood their stakeholder groups. They've been able to shift things around. They've been able to move their products. They've been able to move their relationships. They've been able to carry their employees with them. They've carried investors with them. And that's the new holistic way. For CFOs, that's the world that they have to manage. That's the world that they have to make sense of for boards when boards are making their decisions. It is a multi-stakeholder world, and people have woken up to that in pretty short order over the last 6 months.
Yes, Geraldine, and then I want to go to Rodney to talk about preparedness for regulated ESG reporting that Andrew started to hint about.
Am I allowed to be controversial?
Of course.
Okay. Listening to this conversation, okay, I put my colors up straight away. I'm a chartered accountant. But if I was to say, where is the resilience going to come from? It's the management accounting profession. Because Andrew, you've said it the most beautifully I've ever heard it said. So I really want to applaud your mindset, because it is spot on. It is exactly where resilience comes from. You build trust. How do you build trust? By respecting the stakeholders that you operate with, that you live amongst. When you have that respect, then when push comes to shove and times are hard, people help each other out. If you're in it on your own for your own self-interest, unfortunately, that's when it goes the other way. And I'll give you a very, listening to you, there's a very specific example. When you go into a crisis, it's actually much better to have inventories at hand. So, because if you've pushed down your working capital to the bone, then you have one glitch on the supply chain, and not only can you not produce, you cannot supply your customers. Now, we are embedded in the food space, and during the crisis, food was critical. And of course, medical appliances and PPE, etc. We have received so much applause from our customers because we were able to supply. But how did we do that? We said, forget about inventory levels. Yes, cash matters, but I'd rather try and manage the cash situation in a different way than trying to be cute on inventory. And that balance of how do you run a company for the mid to long term and not for that quarter is really where I believe if you said, Peter said accountants will save the world, I will add management accountants will save the world, because I think there's too much focus, if I'm honest, on external reporting. Yes, external reporting matters. And I fully agree, to get your investors on board and the right capital, it helps, it's needed. But if you make the wrong decisions as a company, then you're for sure not resilient. So that is where I think there could be, I hope we taped what you said, and that can be broadcast to all, the constituents of your organizations, because that's the solution that we're looking for.
Well, you both have convinced me that I need to start a new career and become a management accountant, and the sooner the better. Rodney, your views on this. One of the findings of Edelman's Investor Trust Barometer is that a substantial majority of investors believe that companies are not prepared for regulated ESG reporting. We see the NFRD in Europe, the movement on the EU taxonomy. Perhaps this is more of a US perspective than a European or global one. But what do you see as the impact of the NFRD and the EU for globally, and is there a trickle-down effect to US companies?
Well, I mean, this is a very loaded and open-ended question. In 2002, when Enron went belly up, and 2001, and we had WorldCom, one might argue that globally, nobody was ready for the Sarbanes-Oxley Act. 14 lines in Section 404 resulted in $1 billion industry for the accounting profession to get its act together. So when regulation comes, even the things that we should have been doing, like good internal control, we were seen with our pants down. And so I think it's only fair to say that if ESG does become regulated, many companies will find that it will be a struggle to become compliant. Now, this raises two questions for me. I'm all in favor of regulation, but there's an awful lot of bad regulation out there. WBCSD developed the reporting exchange in 2017 over a 3-year period that mapped the reporting landscape. And of the 2,100 approximate reporting provisions that exist in 73 countries, 85% of those provisions are already regulated. So there's already a regulatory reporting obligation out there today. But it's very niche, and companies are somehow managing to do that, or they're doing it without really seeing too much enforcement. We at the World Business Council believe that regulation is needed, but we need the appropriate regulation, and we need the level playing field to be one that definitely addresses what Kevin has been talking about, which is financial materiality. But if I could be a little bit controversial, I think we also need to address the elephant in the room, and that is the double materiality that perhaps is being debated in Europe. And that's where I think companies are somewhat struggling, and where the accounting profession has been somewhat slow in addressing. There are actually many industries today that are incompatible with a sustainable world if they do not evolve and change. And I'm delighted that we have DSM here today, because DSM as an acronym used to stand for Dutch State Mines. This was a mining company 30, 40 years ago, and it has evolved itself into life sciences, and therefore has a very valuable role to play in the world going forward. But if companies that are part of today's problem and are considered to be valuable in the investment world, but are not compatible in a sustainable world, then we only have accounting rules that allow value destruction in the way of impairment. How do we go in to manage declines for businesses that either can't or fail to transition into more sustainable outcomes? So I think we welcome the approach that we see with the non-financial reporting directive, but it needs to be the right amount of regulation. And there needs to be comparability, but not slavish comparability that forces people into ticking boxes that perhaps shouldn't be ticked. At the WBCSD, we believe business needs to be at the table when these regulations and these discussions are taking place. Companies like DSM and many other members of the WBCSD have so much experience here that they need to impart that experience to the regulator and the policy setters. But I do agree that it will be a problem for many businesses, and the CFO might find that he or she has value destruction to play with if they're not preparing for the inevitability of regulation.
Kevin, it looked to me like you had some thoughts on this. Do you want to share them now?
Sure, thanks for that. And I really want to support what Rodney said just about a couple of things. One is I can definitely see a role for regulation going forward. As I said at the outset, I think the regulation needs to be in the context of a global framework, because otherwise if we end up with a fragmented regulatory system around the world, given that these issues are global and companies are global, it's going to be a world of inefficiency and hurt for us, I think. So that's why I'm really hoping that the IFRS Foundation will pick up the mantle and we'll have a global framework or construct to work within. I think in terms of how the regulation applies to any particular entity, again, I think we really have to make sure that in this process, we don't undermine the role of the boards, because the corporate boards have a lot of responsibility, or should have, and should really be looking at those issues that are financially material or potentially financially material to its business in terms of opportunities and risks, and have the reporting out on that. So I think it's very important that we don't undermine the role of the boards. And very important, I think, as Rodney said, that this process not turn into a box ticking or boilerplate or greenwashing exercise, because that won't help anybody down the road. So I think it's just important to keep those particular issues in context as we move forward.
Just a few thoughts from the US perspective on this. A lot of talk about what the SEC may do under a new administration. What I'm hearing is that the question of whether is a yes. The question of how is wide open. Some say, oh, we need to redefine the materiality standard under SEC disclosure rules. Maybe we just need to rethink what is considered material. Companies know their business. They need to make the decision about what is material. Our understanding of these systems are improving. So perhaps there's a mindset shift in order, particularly for the accounting and financial services professions. And your conversation also makes me think about whether there's going to be some sort of battle to redefine the P&L. Is there a chunk of the P&L that's missing that relates to double materiality? Are there externalities that need to be introduced into the P&L? Andrew, do you have any thoughts about that? Realizing that I am not an accountant and this question may be completely irrelevant.
Heidi, I think it's a great point. The P&L links your balance sheets from one year to the next. And what we have, what we know full well is, 10 years ago, your balance sheet represented probably only 20% of corporate value. Now it's probably really displaying only about 10% of corporate value. Go back to the 1970s, it was showing 80% of corporate value. So there is an awful lot missing in our current reporting reporting framework. Not just it's not just around P&L. It's missing in balance sheet as well. Some of the work that Geraldine's business has been doing around this starts to fill those gaps. But again, we come back to the need for the need for a solution, and Kevin's comments about the need for a global solution. Business is global, and he's absolutely right. If we don't get a global solution, it will be a world of pain, and we not only that, but we ultimately that complexity will lead us not to be as successful as we'd like to be.
Just quick, are you all aware of any sort of incubators or pilots in terms of here's what the P&L, the balance sheet look like today under current rules and regulations? What could it look like if we made an attempt to reshape it?
There are some incubators out there, and in Germany, the Value Balancing Alliance has been working with a lot of German and other businesses, as well as the big four firms in Germany, to look at this concept of P&Ls and the so-called balance sheet of the future. But a lot of it is based on assumptions and black box type data that perhaps is not always easy to understand. And then you get into the moral dilemma of whether or not you should be netting off environmental and social positives and negatives, or even if you can put a price on some social impacts and dependencies, because there's this obsession with monetization. So yes, there is some incubators out there. The big four, certainly PwC, KPMG have all developed their own proprietary models that they sell to clients that help with monetizing financial ESG statements. But what was supposed to be a decision-making type tool have made their way into external disclosures, and for the uninitiated audience have become almost like quasi-financial statements that people start to rely on, even though they're inherently flawed with assumptions. So that's why we need the profession to take hold of the reins here and allow this to be more transparent.
Geraldine, I'm seeing you thinking.
Yeah, no, I'm actually entirely with Rodney on the problem with monetizing all of these things is that it becomes then not a decision tool anymore. It is some sort of a black box that pops out a number, and then somehow it's supposed to mean something. So we're very, very how do I say? We've tested it out, and it really didn't help the organization. So be very cautious. But I was actually thinking back to your question on the balance sheets and the P&L. I mean, there's certainly the balance sheet doesn't reflect the full value of companies, but it also doesn't reflect the full liabilities that companies should be carrying. And there's two reasons for that. One is the externalities are not reflected. And you can see that when looking back at history. And as Rodney said, once upon a time, we were a mining company. Land reclamation, cleanups, etc. At the time, it wasn't even considered as a byproduct of the activity. Now, as time went forward, there was a realization companies should put back what they've taken in terms of sites. And now that is reflected in sort of environmental liabilities, that kind of thing. But there's so many other externalities that currently completely float away. So that's one of the issues. The other one is something that accountants and economists have invented, and that is the discounting factor. So that something in the future is less important than something today. And that is so dangerous, because a negative outcome 10 years beyond, from 10 years and thereafter, if you do a net present value, and even if it is a catastrophic risk, you still have an outcome that you're better off doing it. And that is something that, for all the right reasons, we thought was a good idea of representing the time value of money, but it's actually driving short-termism in mindset, because then you do NPVs and you do IRRs and you do all of these assessments to see whether a project is worth doing, and you can virtually completely ignore a catastrophic exposure because it is a little bit further down the road than we're used to managing. So there are a lot of fundamental questions that one can ask in terms of whether our accounting norms and principles are still reflective of the way we should manage our actions. So I think that's a very good question.
As a former lawyer, you're reminding me that the relationship between the corporate form and society is based on contracts, at least in my jurisdiction. in exchange, the state represents the citizens, and the corporation goes to the state as representatives of those, as the representative of those citizens, to request a license to operate, which it receives through the submission of a charter. Maybe it's not just the accounting rules that need to change, but we need to revisit that contract, and that's where policy comes in. And here comes Rodney.
Yeah, I mean, when Peter Backer coined the phrase "accountants will save the world," it was in response to the Rio 20 Plus conference that took place in 2012. But as I've evolved in my work at the WBCSD, I do think that the next big bastion of change needs to be the legal profession, and that perhaps the key here is that lawyers will save the world. Because anybody that's ever had to work with a US listing will know that it's not the accountants that cause problems at the end of the day, it's the lawyers and what you can get away with by disclosure. And as somebody that worked in risk management, wanting to disclose the real risks of the business and the real opportunities for solution was sometimes underplayed by the SEC lawyer that was brought in to advise. So perhaps we need to not just look at the accounting saving the world, but that professions that advise business in general need to change and address not only the risks that we have today, but the opportunities that this agenda presents.
Rodney, I think that is a perfect opportunity to perhaps conclude with each of your thoughts on what can individuals, accountants, what can individual CEOs do on a practical day-to-day level to make this move to multi-stakeholder capitalism viable, for lack of a better word, because I can't think of one, and successful. Andrew, I'd like to start with you, then Geraldine, Rodney, and Kevin, as the CEO of IFAC, will conclude with you.
I'm going to give a very, very simple piece, which is change your scorecards. That top level front sheet that your board sees when it's looking at its performance needs to reflect this new paradigm. It needs to reflect the multi-stakeholder environment, and it needs to really be looking at long-term value creation.
Geraldine, why don't you go next?
If you really look at the business that you're running as a CFO, as a finance organization, and don't think of it for the next quarter, but look at it with a 5 to 10 year horizon and say what matters to be successful on that time frame, and then work backwards and say, well, if that is true, then how should we change the way we plan, the way we measure, the way we incentivize, the way we allocate capital? So start from the longer horizon and come back. Right now, we are quarter after quarter running after things, and you just never lift up that chin and figure out, and you can indeed drive yourself off the cliff very easily if you're not careful. So for me, simple advice, start 10 years out and come back. And by the way, for bigger infrastructure businesses, you're probably looking at 25, 30 years out, depends on the business, but further than the normal cycle that your activity would entail.
Rodney, you mentioned the lawyers. We're speaking to accountants. What's your recommendation for taking action right now?
Okay, well, I've got some practical recommendations and one philosophical. So on the practical side, your company is already producing publicly facing data. Get in control of that data. Apply your internal control mechanisms and your staff that do that work to this data capture and collection, and make sure that where possible, it is free from material misstatement. Involve your internal audit function where possible as well. Revisit the way in which you prioritize and identify risk. And I would, if you're looking for inspiration, I would encourage you to read Rick Funston's seminal work of 2007 called The Risk Intelligent Organization, which really is the work that I believe is what business should be doing. Get away from probability as a determinant of risk and look at your vulnerabilities, because that's what COVID-19 has taught us. Remember that you are a professional accountant and therefore have a duty to remain current in your skills. So irrespective of what age you are, remember to re-educate yourself. And this stuff is important. So seek out courses to become educated on ESG. If you are disclosing information, seek reasonable assurance. And if you have good internal controls, the cost of that should be relatively negligible. And finally, from a philosophical point of view, go and stand in front of the mirror and take a cold, hard look at yourself as a professional accountant. And remember that you've signed up to a code of ethics and that the professional body that you're part of probably was founded with the public interest in mind. I'm a member of the Irish Institute of Chartered Accountants, or Chartered Accountants Ireland, as they rebranded themselves. And in 1888, we were founded to act in the public interest to ensure that information was available to investors to make smarter and more informed decisions. The biggest public interest we have today is ensuring the survival of the planet and the citizens that are on it. And therefore, it is implicit in our code of ethics that we act accordingly.
All right, Kevin, you represent numerous accountants globally, many of whom are listening to this conversation. What do you recommend to your membership and the profession for how accountants can save the world?
Thanks, Heidi. And it's pretty hard following what Andrew, Geraldine, and Rodney have just said, because I would like to echo all of their comments, but I'll try not to repeat them. I think what I would say to the individual accountant, and that's who this message is directed at, is embrace this new world. Be out there and anticipate the opportunities that are there for the business, the risks that are there for the business, and really just embrace the world. It's going to be a lot of change management. You're going to have to learn some new skills. You're going to have to, learn to work with different people with, different areas of expertise. But this is a brand new world, and it's just a world of opportunity. And I think if they do that, and whether you're inside the business, working in terms of getting integrated thinking, working within the business, changing the mindset inside the business, or whether you're working as an external advisor in terms of, providing assurance on that or advice to the business, just really think about what the world can be, change yourself, and something, you will be more valued as an individual advisor, employee going forward. And there's nothing better in life than to be more valued than you are now. So that would be my very simple thought for any individual professional accountant, wherever they are in the world and whatever sector they're in.
Well, Kevin, thank you for that very positive and encouraging message. I also want to thank you for the privilege of being your moderator. I certainly began a new education today and got wonderful ideas for me to be thinking about. So thank you again, and really hope to continue this conversation with all of you